in this video we are going to see about a few more financial appraisal techniques. So first one is profitability index. So in the previous video we have seen about what is net present value and payback period. So in this video we are going to see rest of the three financial appraisal technique. So first one is profitability index. Profitability index, otherwise we can call it as a benefit cost ratio. Cost benefit ratio or benefit cost ratio we can call it as. So the profitability index measures the ratio between present value of future cash flow and the initial investment amount. The index is a useful tool for ranking investment project and showing the value created per unit of investment. So yes, what is profitability index? So how much if I am investing 10 lakh rupees over a year, if I am taking 20 lakh, then my profitability index will be 2. So just how much I am taking out of it divided by my investment amount. If I am running my particular business for 10 years, if I am getting some amount of 1 crore, my investment amount is 10 lakh, then 10 lakh will be my investment amount and what is revenue or a profit what I am going to get it out of it. So 1 crore divided by 10 lakh will be my profitability index. How much time I am getting my investment amount. That means profitability index. Based on this profitability index, you can easily select the projects or investment options or a kind of business, because it's a kind of ratio, so that you can accurately take, or in the financial appraisal technique itself, the first priority goes to profitability index. How much profit you are getting out of that particular business or a project or the investment option. So profitability index plays a vital role. That plays a priority one. The most important priority in financial appraisal is profitability index. How much profit I am getting out of it with my investment amount or with my capital. So that's all about profitability index. So profitability index formula is cash inflow divided by cash outflow. Cash inflow divided by cash outflow. Yes. So that's why they mentioned initial investment, it's cash outflow. Cash inflow is present value of future cash flow, we will be calling. So cash inflow divided by cash outflow will be profitability index. So yes, you can calculate this profitability index through normal hand calculation also you can do, through Excel sheet also you can able to do. Yes. Yes. Next is as I told, profitability index is also called as benefit cost ratio or cost benefit ratio. So a benefit cost ratio or cost benefit ratio is an indicator showing the relationship between the relative cost and the benefit of the proposed project, expressed in monetary or quantifiable or qualitative terms, quantifiable and qualitative terms. If your project has benefit cost ratio greater than 1, the project is expected to deliver a positive net present value to the firm or their particular investment. Yes. So this is all about profitability index, right? So we'll see next financial appraisal technique. So accounting rate of return, otherwise we can call it as an average rate of return. Accounting rate of return we also call as average rate of return. Everyone will be having confused what is average rate of return, what is accounting rate of return. In the financial appraisal technique, both are same. So accounting rate of return is a financial ratios used in capital budgeting. The ratio does not take into account the concept of time value of money, because it comes under non-discounting technique. So they won't consider the time value like payback period. They will be using future cash flow for this. So ARR calculates the return generated from net income of the proposed capital investment. ARR is a percentage return. So it will be like a ratio or it's a percentage related one. Accounting rate of return or average rate of return. So the formula is average net income divided by average investment. If I am running my business for 10 years, I have to divide it by 10. The total income of 10 years divided by 10. If I am investing some 10 lakh or 20 lakh at the initial or and for the entire period of 10 years, what I want to do is initial amount divided by the 10 years. So I can able to get accounting rate of return or I can able to get average rate of return. Average net income divided by average investment. So through hand calculation also you can able to obtain, you can use Excel sheet also. Yes, next, the last and final financial appraisal technique is IRR, internal rate of return. So internal rate of return can be calculated through trial and error method. Very typical method for normal hand calculation. So what is internal rate of return? Internal rate of return is a metric used in financial analysis to estimate the profitability of the potential investment. What is the profitability or profit percentage of that particular thing? The internal rate of return is discounted rate that makes the net present value of the all cash flows equal to zero in a discounted cash flow analysis. So IRR is an internal rate of return, the profitability of an business or an investment or a project. So that's how much rate we can get it out of it, or how much percentage we are getting out. We can calculate from that. Fine. So what is the formula or how we can calculate IRR? Yes, this is right. So it's by using trial and error method, we can calculate this IRR, internal rate of return, the cash flow. In IRR, we will be considering time value of money. So we will be using future cash flow as the future cash flows. From the future cash flow, we will calculate the present cash flows and so on. So this is what it's all about. Here the R is IRR. Here the R is IRR. So based on the IRR, we have to assume and we have to work for this IRR, so that you can able to obtain IRR, internal rate of return, through normal calculation in hand. Also you can able to obtain. Even you are having in Excel sheet you are having IRR function, so that you can easily come out with IRR percentage. Yes, thank you all. Thank you.